The Relative Strength Index, RSI, is a momentum oscillator used to quantify the speed and magnitude of price movements. It helps traders evaluate overbought, oversold, and momentum shifts. It was developed by J. Wells Wilder Jr. and introduced in 1978. Core concept. RSI measures average gains versus average losses over a defined lookback period, default 14. The output is normalized between 0 and 100, which makes interpretation consistent across markets. Interpretation ranges. RSI above 70 typically indicates overbought conditions. This does not guarantee a reversal. It indicates strong upward momentum that may be extended. RSI below 30 typically indicates oversold conditions, suggesting downside momentum may be stretched. RSI around 50 represents equilibrium. Momentum is neutral. Many traders treat the 50 line as a trend filter. Formula logic simplified. RS equals average gain, average loss. RSI equals 100 minus 101 plus RS. The smoothing method uses exponential style averaging, meaning recent price action has more influence than older data. Default settings. 14-period RSI is standard. On a 1-minute chart, that means 14 minutes of data. On a daily chart, 14 days. Shorter periods, e.g. 7, make RSI more sensitive. Longer periods, e.g. 21, make it smoother. Overbought, oversold is contextual. In strong uptrends, RSI can stay between 40 to 90. In strong downtrends, RSI often stays between 10 to 60. Because of this, many traders adjust thresholds. Bull market, 40 oversold, 80 overbought. Bear market, 20 oversold, 60 overbought. Divergences. Bullish divergence occurs when price makes a lower low, but RSI makes a higher low. This suggests weakening selling pressure. Bearish divergence occurs when price makes a higher high, but RSI makes a lower high. This suggests weakening buying pressure. Divergences are early signals, not immediate entry triggers. RSI trendline breaks. You can draw trend lines directly on RSI. When RSI breaks its trendline, momentum shifts often occur before price breaks. This is commonly used for early entries. RSI 50 line strategy. Above 50, bullish momentum bias. Below 50, bearish momentum bias. Many traders only take long trades when RSI 50 and short trades when RSI 50. RSI as support resistance. RSI often respects horizontal levels such as 40, 50, 60. Repeated bounces at these zones indicate consistent momentum behavior. RSI swing rejection strategy. Bullish, RSI drops below 30, moves above 30, pulls back but stays above 30 or 30, breaks prior RSI high. Bearish, opposite logic near 70. This focuses on momentum structure, not just levels. Best time frames. Scalping, 1 minute to 5 minute RSI, more signals, more noise. Day trading, 5 minute and 15 minute RSI. Swing trading, 1 hour and daily RSI. Higher time frame RSI tends to be more reliable. Common combinations. RSI plus VWAP. Take long only when RSI oversold near VWAP support. RSI plus moving averages, filter trades in trend direction. RSI plus volume, confirm momentum with participation. RSI plus support resistance, strongest confluence. RSI pitfalls. Overbought does not mean sell. Oversold does not mean buy. RSI can stay extreme during strong trends. Low volume stocks produce unreliable RSI readings. Advanced RSI techniques. RSI range shift. Identify when RSI transitions from bearish range to bullish range, 40-80. Multiple timeframe RSI. Align 5 minute with 1 hour momentum. RSI compression. When RSI tightens near 50, expect expansion soon. RSI failure swings. RSI fails to reach prior high low, signaling momentum exhaustion. Day trading usage. Most day traders use RSI as confirmation, not primary entry. Example workflow. 1. Identify trend, VWAP or moving average. 2. Wait for pullback. 3. Use RSI oversold and uptrend for entry. 4. Exit when RSI approaches 70. Best markets for RSI. RSI works best in range-bound markets. In trending markets, use adjusted levels or trend filters. Summary. RSI is a momentum strength gauge, not a standalone signal. It performs best when combined with trend direction, volume, and key price levels. Used properly, it helps avoid chasing extended moves and improves timing. Several RSI-based strategies are commonly used because they exploit different market regimes, mean reversion, trend continuation, and momentum shifts. The effectiveness depends on volatility, time frame, and whether the market is trending or ranging. 1. RSI oversold pullback and uptrend, trend continuation. This is one of the highest probability uses. First, establish trend using moving averages, VWAP, or structure. Then wait for RSI to drop below 30 during a pullback. Enter when RSI crosses back above 30, ideally near support. Exit near RSI 65 to 70 or prior resistance. This works because strong trends repeatedly reset momentum without reversing. 2. RSI overbought pullback and downtrend, the inverse logic. In a downtrend, wait for RSI above 70. Enter short when RSI drops back below 70. Exit near RSI 30 to 35. This strategy performs best in weak markets with persistent selling pressure. 3. RSI 50-line momentum strategy. The 50 level acts as a momentum pivot. Long setup, RSI crosses above 50 while price breaks resistance. Short setup, RSI crosses below 50 while price breaks support. This strategy filters out counter-trend trades and aligns with directional momentum. 4. RSI divergence reversal strategy. Bullish divergence, price makes lower low, RSI makes higher low. Enter when price breaks minor resistance after divergence forms. Bearish divergence, price makes higher high, RSI makes lower high. Enter on breakdown. This is effective near key levels like daily support resistance, but should not be used alone. 5. RSI range shift strategy. Market shift between bullish and bearish RSI ranges. Bullish regime, RSI stays between 40-80. Bearish regime, RSI stays between 20-60. Strategy, buy when RSI bounces near 40 in bullish range, short when RSI rejects 60 in bearish range. This is particularly useful for trending stocks. 6. RSI swing rejection strategy. Bullish sequence. RSI falls below 30, RSI returns above 30, RSI pulls back but holds above 30. RSI breaks previous high, entry occurs on that break. This confirms momentum structure rather than reacting to a single reading. 7. Multi-Timeframe RSI alignment. Use higher time frame for bias and lower time frame for entry. Example, 1 hour RSI above 50, bullish bias. Take long entries only when 5-minute RSI dips below 30 and turns upward. This reduces false signals significantly. 8. RSI plus support resistance confluence. Wait for RSI oversold at horizontal support. Enter when price holds level and RSI turns up. This improves reliability versus using RSI alone. 9. RSI breakout confirmation. When price breaks resistance, check RSI. If RSI is already above 60 and rising, momentum supports breakout continuation. Avoid breakouts where RSI is weak or diverging. Best overall strategies for day trading ranked by reliability. 1. Oversold pullback and uptrend. 2. 50-line momentum strategy. 3. Multi-timeframe alignment. 4. Range shift strategy. 5. Swing rejection. 6. Divergence reversal. 7. Overbought oversold counter trend alone, least reliable. The indicator was designed by J. Wells Wilder Jr., but modern usage emphasizes combining RSI with trend context rather than using raw overbought oversold signals. 1. RSI oversold pullback trend continuation. This strategy assumes the dominant trend remains intact and uses RSI to time entries during temporary weakness. First, define the trend objectively. Typical filters include higher highs and higher lows, price above VWAP, or price above a rising moving average. Once trend bias is confirmed, wait for a pullback. The key condition is RSI dropping below 30 while price approaches a logical support level such as prior breakout, VWAP, or moving average. Entry occurs when RSI crosses back above 30 and price shows stabilization, e.g. small consolidation or bullish candle. Stop placement is usually just below the pullback low. Profit targets can be prior high, measured move, or when RSI approaches 65 to 70. This works because strong trends repeatedly experience controlled pullbacks that reset momentum without reversing. Avoid taking signals when price breaks structure. That indicates trend failure rather than a pullback. Refinements. Shorter RSI period, 9 to 10, improves responsiveness for intraday trading. Use volume confirmation. Low volume pullbacks are stronger setups. Avoid trades when RSI drops deeply below 20. That often signals stronger selling pressure than a simple pullback. 2. RSI 50-line momentum strategy. The 50 level acts as a directional equilibrium. Above 50 implies average gains exceed average losses. Below 50 implies the opposite. The strategy focuses on momentum transitions rather than extremes. A long setup occurs when RSI crosses above 50 while price breaks resistance or exits consolidation. A short setup occurs when RSI crosses below 50 while price breaks support. This method works well during emerging trends and breakout environments. Entries should occur close to the break, not after extended movement. Stops are typically placed below the breakout level for longs or above it for shorts. Exits can be momentum-based, RSI reaching 65 to 70, or structure-based, next resistance support. Refinements: use RSI slope. A steep angle above 50 indicates strong acceleration. Combine with volume expansion to validate breakout strength. Avoid using this strategy in sideways markets where RSI whipsaws around 50. 3. Multi-Timeframe RSI alignment. This method reduces false signals by aligning higher timeframe bias with lower timeframe entries. The higher timeframe determines directional preference. For example, if the 1-hour RSI is above 50, only long setups are considered. The lower timeframe, e.g. 5-minute, is then used to time entries when RSI becomes temporarily oversold. The logic is that short-term weakness within higher timeframe strength provides optimal risk to reward. Entry occurs when lower timeframe RSI turns upward from oversold, while higher timeframe RSI remains bullish. Stops are placed under the local swing low. Targets are based on intraday resistance or trailing momentum. Example workflow. Step 1, check 1-hour RSI. Above 50, bullish bias. Step 2, monitor 5-minute chart. Wait for RSI below 30. Step 3, enter when 5-minute RSI crosses back above 30. Step 4, exit when 5-minute RSI reaches 65 to 70 or price hits resistance. Refinements: use 15-minute as an intermediate filter for smoother alignment. Avoid trades when higher timeframe RSI is near 50. Bias is unclear. Best used during trending sessions with clear directional movement. These strategies build on the momentum principles introduced by J. Wells Wilder Jr., but adapt them to modern intraday trading, where combining trend context with momentum timing significantly improves signal quality. The optimal RSI timeframe depends on trading horizon and volatility. RSI measures momentum relative to the chart interval, so its reliability increases as timeframe increases, but responsiveness decreases. Scalping: 1-minute to 3-minute charts. RSI reacts quickly and generates frequent signals. This is useful for rapid pullbacks and micro-momentum trades. However, noise is high and false signals are common. Many scalpers reduce the period to 7 to 9 to increase responsiveness, best used with strong trend filters like VWAP. Short-term day trading, 5-minute chart. This is widely considered the most balanced time frame. Signals are frequent enough for multiple trades, but less noisy than the 1-minute. RSI oversold pullbacks and 50-line momentum strategies work well here. Many traders use standard 14-period RSI. Intraday trend trading, 15-minute chart. More reliable momentum structure. Divergences and range shifts are clearer. Signals occur less often but carry more weight, useful for holding trades longer within the same trading session. Swing bias confirmation, 1-hour chart. This time frame is often used as a directional filter. If RSI is above 50 on the 1 hour, traders prefer long setups on lower time frames. It reduces countertrend trades and improves win rate. Swing trading, daily chart. Daily RSI provides strong overbought oversold signals and meaningful divergences. These setups often lead to multi-day moves. Fewer signals but higher reliability. Best multi-time frame combinations. 1 hour for bias plus 5-minute for entries, common for day trading. 15-minute for bias, 1 minute for scalping. Daily for bias, 1 hour for swing entries. General guideline: lower time frame RSI equals faster but noisier. Higher time frame RSI equals slower but more reliable. For most day traders, the most practical setup is 5-minute RSI for entries, 15-minute RSI for confirmation, 1 hour RSI for trend bias. The indicator's behavior across time frames follows the original momentum design introduced by J. Wells Wilder Jr., but modern usage emphasizes multi-time frame alignment to filter false signals.